So you want to get the IRS off your back. You submit an offer in compromise, but it's rejected. Why? It probably has something to do with your monthly living expenses and something called the collection financial standards. In today's video, we're going to go over the collection financial standards and how they relate to your monthly living expenses and how that's probably what doomed your offer in compromise. On the other side of the break.
1877 Levy King, Levy Levy King, 1877 Levy King, LevyKing.com.
What's up, guys? Corey Hankerson here from Legacy Tax, and they call me the Levy King because I've literally helped thousands of clients with unfiled returns, tax liens, and that's right, IRS levies. And I'm also the author of End the Tax Nightmare, Insider Secrets to Beat the IRS and Reduce Your Tax Debt. And I want to give you a free copy of my book, End the Tax Nightmare. All you got to do is jump on over to www.endthetaxnightmare.com, pop in your information, and I'll email you a copy of the book absolutely free. Inside the book, we talk about how to stop IRS liens, levies, and garnishments, even if you can't afford to pay the tax in full, how you can set up the payment plan that you want and not the one that they want, and how you can potentially settle your tax debt for less than you actually owe. Just jump on over to endthetaxnightmare.com. You can download a copy of the book for free. If you'd like to give my office a call and speak to us live, you can do that by dialing 1-877-LEVY-KING, and we'll be glad to help you. All right, so let's dive right into today's video. We're going to talk about the collection national standards and how they can blow up your offer. All right, so here's the deal. Let's say you owe $20,000 in back taxes. You have no assets, and at the end of the month, you're out of money, right? So your monthly expenses exceed your monthly income, okay? So you jump over to one of the many offer and compromise calculators that you can find on the internet, and you determine that it's probably, reasonable. There's probably a good likelihood that the IRS would accept an offer and compromise, and you can probably offer something close to zero, right? Like a very small amount, because again, you don't have any assets and you have very little income, but your offer is rejected. And the question is, why did that happen? Well, it's likely because the IRS did not give you full credit for all of your living expenses. Instead, they applied the collection financial standards, and in doing so, they calculated that you can pay them more on paper anyway than you can actually pay in real life. And that is because the IRS routinely limits your living expenses as part of their offer and compromise analysis. This is where lots and lots of offers go wrong. In other words, the IRS will put you on their budget and disregard your actual budget. Okay, so if your living expenses are greater than the IRS's budget, your real expenses are going to be ignored by the IRS, which they're going to take into account in calculating your ability to pay them back. This is going to increase your cash flow and also increase the amount that you're going to have to offer if you want your offer and compromise to be accepted. You see, decreasing your living expenses and increasing your cash flow now results in a calculation, probably an inflated calculation, that you have a larger ability to repay your tax debt. Again, that's on paper, right? But that's going to be greater than your actual ability to repay the debt in real life. The IRS's living expenses guidelines are known as the collection financial standards. Collection financial standards. Blah, getting tongue-tied. Anyway, link in the description below. So you can jump down to the link and pop over to the IRS's website and get a look for yourself as to what those collection standards are. And you let me know in the comments, do the numbers that the IRS has on the collection financial standards for your particular town, because it's broken down by city, state, and zip code, does that correspond to what the actual expenses are where you live? For example, would they allow for your housing and utilities? Let me know in the comments below whether that corresponds to your actual housing and utilities. I'm always curious to know how that corresponds to real life. Anyway, so here are a few examples. Let me give you just a few examples so you can see how the collection financial standards, which the IRS uses and which they use to evaluate an offer, how that corresponds to an offer, to a real offer. Okay, so first example is a car payment, right? So let's say you drive a 3-year-old SUV and you have a monthly car payment of $650. Okay, the collection financial standards currently allows a car payment of up to $531 a month. So what that means is if you have a $650 car payment, but the standard only allows $531, then that means you have an overage of $121 a month, right? So that $121 monthly overage will be disallowed. The net result is the amount that you have to offer to the IRS in order to have your OIC accepted needs to be significantly larger, okay? So, and obviously that situation is twice as bad if you have 2 cars, which many families do, right? If you got a husband and wife, 2 or 3 kids, you probably have 2 cars. Well, if both of those cars are over the standard, then the overage will be disallowed in both instances, which sort of doubles your trouble, okay? And of course, if you have more than 2 cars, if you have 3 cars, then that 3rd car payment is going to be disallowed entirely because the standard only allows for 2 car expenses. The second example here has to do with credit card payments, okay? So let's say you have 8 credit cards and the minimum monthly payment on all of those cards together, all of the minimums together totals $600 a month, okay? Why am I talking about the minimums? Because the IRS's collection standard only takes into account what the minimum monthly payment is. If you're sending more than the minimum, then everything over the minimum is going to be disallowed anyway. But in this example, let's say you're sending in $600 a month. Traditionally, the IRS did not allow credit card payments when calculating the amount that you had to offer with an OIC. Today, that's a little bit different. So sometimes they will accept credit cards, sometimes they won't still, and then sometimes they'll accept some, but not others. So if you have 8 cards, maybe they'll accept 4 of the minimum payments, but not all 8. A situation like that is an area where it pays to have a little bit of skill and some experience and some strategy in negotiating with the IRS. So if they ignore all of those expenses, if they ignore all of those minimum payments for those 8 credit cards you have, then that means that the amount that you have to offer is going to be significantly increased because your monthly budget was just affected by $600 a month. So again, we're changing the amount that you have to offer in order to have your OIC accepted. Now, the third one is an area that's also very ripe for negotiations, and we see a lot of back and forth with the IRS in terms of housing and utility payments. Okay, that's our third example. So I recently had a family that lived in the suburbs of Washington, D.C. Their monthly mortgage was $2,950 a month for the family. The gas, electric, water, and all the other utilities totaled $550 a month. So that brings their total for mortgage, their housing and utility costs to $3,500. That's their actual cost, okay? However, the collection financial standards for this particular area where they lived gave them an allowable expense of $2,441. They're actually spending $2,950. The IRS only allowed, they're actually spending $3,500. Correction, they're actually spending $3,500. The IRS only allowed $2,441. So that leaves a difference of $1,059 that the IRS wanted to completely exclude from their budget. That would have thrown their offer and compromise completely out the window because they simply wouldn't have qualified. So on these 3 items alone, right, you got a credit card payment, a car note, and a house note. On those 3 items alone, you're talking about $600 a month for the credit cards. That's potentially going to be disallowed. $121 a month for the car note. That's potentially going to be disallowed. And $1,059 a month for the housing and utilities. That's the overage that's going to potentially be disallowed. These 3 items alone would take an offer that probably would have been accepted because you had no income left over at the end of the month and turn it into an offer that's probably going to be declined. Why? Because the IRS has concluded that you have $1,780 left over at the end of each month that you must now use to repay your tax liability. And if you use that money at the end of each and every month to repay the tax liability, the debt will be paid off in less than 12 months. So therefore, they are bound to decline the offer. Okay. In other words, you said in your budget that you didn't have any money left over at the end of the month to pay the tax because your expenses in real life exceed your income. But the IRS, using the collection financial standards, have determined that, at least on paper, you have $1,780 left over at the end of the month. And because of that, they're going to decline the offer. So that's the way that shakes out. So the question is always, how do I get the IRS to use my real figures, my real numbers, my real monthly expenses, and not use what the collection financial standards provide should be my expenses, what they determine should be my budget, my monthly income? Well, you're going to have to hold on for another video, right? I can't give it all away in just one video, but we'll cover that in a subsequent video. But what I want to impress upon you in today's video is that when you're negotiating a settlement, it's really their reality, not necessarily your reality, that's going to control the situation. At least reality as it comes to your monthly expenses, that's going to control the situation, right? So you have to sort of know what the rules are, and particularly the rules that the IRS uses, what those rules are, before you can talk about how to bend the rules and how to sort of wiggle in where, at least at first glance, you may not necessarily fit, right? So that's the deal there. All right, guys, if you owe back taxes to the IRS or the state, I want you to know that there are special programs in place that can allow you to get a fresh start as it relates to your tax liabilities and get out from under that tax debt. But how do you know if you qualify? You see, each tax case is entirely unique in a lot of ways, in a lot of circumstances. They're not just cookie cutter, one size fits all cases, and they're not cookie cutter, one size fits all resolutions for those individual cases. So how do you know if you, with your unique circumstances and situation, qualify for a fresh start? Well, glad you asked. I want you to go over to my website, www.levyking.com, Levyking, levyking.com, and answer a few short questions, and we'll walk you through the process of determining your eligibility to get a fresh start when it comes to this tax debt. Alternatively, if you don't want to do the website thing, you don't like going online and using the calculator, why don't you give us a call? Give us a call at 1-877-LEVY-KING. That's 1-877-LEVY-KING. You see the phone number below. And again, we'll be glad to jump on the line with you and help you figure out if you qualify for a fresh start. All right. Well, that's it for this week, guys. Hope to talk to you soon. I'm out of here.
1-877-LEVY-KING, LevyKing.com.